Welcome back. I thought it might be helpful to take a look at Bitcoin, especially in light of the massive market sell-off we've seen over the past week or so as a result of the FTX bankruptcy. We can be tempted to buy Bitcoin and the other cryptocurrencies in light of this weakness. So we should first identify the reason why Bitcoin, and this applies to the other cryptos as well, why it sold off. Number one, we can see the market goes down as a result of general market weakness. When stocks and cryptocurrencies and other markets go down, we would not use this strategy in this situation. However, if we see Bitcoin go down for a piece of news that's specific to the cryptocurrency market, such as the FTX bankruptcy, we've had other cryptocurrency exchanges go bankrupt in the past. We've also seen certain countries put on restrictions in trading cryptocurrencies. If that piece of news affects the cryptocurrency market specifically, that's when we would employ this strategy. So, for example, going back to the early days of March 2020, there was a global, market sell-off. Stocks went down, cryptocurrencies went down. The orange line represents the S&P 500. The blue line represents Bitcoin. Both markets went down, not lockstep simultaneously, but there was a global economic sell-off. We would not use this strategy in situations like that. However, more recently, as a result of the FTX bankruptcy, we can see the orange histogram bars show us the price of the S&P 500, which has remained relatively stable. The blue histogram bar shows us Bitcoin, which was above 21,000 and then sold off to around the 16,000 level during the same period of time. In this particular situation, we could apply this strategy. So what is the strategy? It's the S&P 500 Bitcoin ratio strategy. Essentially what it does is it calculates the ratio, the S&P 500 divided by the price of Bitcoin, similar to the gold-silver ratio that we've discussed in other videos here. The way we calculate this is as follows. We take the closing price for one day of the S&P 500 divided by the closing price for one day for the price of Bitcoin. So for example, November 7th, the S&P 500 closed at 3807, Bitcoin closed at 20,589. 3807 divided by 20,589 gives us 0.18. That is our S&P 500 Bitcoin ratio. Number two, identify those instances where the S&P 500 remained relatively flat, or it can go up or down to a small degree, but at the same time while Bitcoin crashes. So the next day, November 8th, S&P 500 closed at 3828, up a couple points for the day. During the same period of time, Bitcoin fell from 20,000 and change to 18,000 and change. The ratio increased to 0.21. From a level of 0.18 to 0.21, you take that rate of change divided by 0.21, that gives us a 12% increase. Now, this is the way it looks in terms of the math on November 7th. We see here Bitcoin 20,589, eventually falling to 15,887, and the ratio increased from 0.18 to eventually 0.24. The blue line on the right-hand side shows us the price of Bitcoin, and the red line shows us the ratio. Notice how the ratio spiked. 10-15% levels are pretty significant. Now, we went back around 7 years testing daily chart data for 7 years and testing this over many different possible approaches. And this is what we found. On the left-hand corner shows us the ratio trade trigger. That's how much the ratio needs to spike in order for us to want to get in. Now, if we see the ratio spike by 1%, we see the average Bitcoin performance, and this measures over 30 days. If you were to buy Bitcoin on average over the past 7 years and hold it for 30 days, you would have a return of investment of around 8%. If you were to use this 1% ratio spike, we would enjoy returns on investment around 7%. Actually, a little bit worse, a 1% decrease in performance. However, notice if we look for a spike of around 12%, meaning that SP 500 Bitcoin ratio increases by 12% on average, while the market returns 8% return on investment over 30 days, this trade trigger would on average return 15% return on investment, around a 7% improvement. If we're going to look for a 17% spike, we would enjoy on average a 29% return on investment, representing a 21% improvement. Pretty significant. Now, of course, past performance is not indicative of future results, but we did test around 7 years of data, and we have pretty significant evidence showing that this is what the data does suggest, that you look for these big spikes, especially in excess of 12%, and we start to see much superior returns when we wait for those instances. This is what the results look like, graphically speaking. On average, we see the Bitcoin performance is shown by the red histogram bars, 8%. If we were to just buy Bitcoin, hold it for 30 days, on average, that's your return on investment. The blue histogram bar shows us if we wait for that trade signal, and we see, especially we get to this 11, 12% area, we start to see a real divergence. We start to see much superior returns on investment, and especially above 17%. So we really want to look for those instances where the ratio spikes at least 12%, but better, 17% or better. That's when we really start to see a drastic improvement. And the green histogram bars show us how much our performance does tend to improve when we wait for those indications. So again, we look back to the strategy very simply. Take a closing price of the S&P 500 divided by the closing price of Bitcoin. You can write that down on a piece of paper, wait for the next day, and see if there's a big spike. We want to see on average at least trade signals around 12% up to the 17% level or higher. Of course, we can look for smaller results, and we will get more frequent trade signals. For example, if we look for a 5% spike, we have over 100 trade signals that occurred, but this will not show us any improvement at all. So it really behooves us to wait for the better signals and then to allocate our capital accordingly. We hope this has been helpful. We look forward to seeing you back soon.